This is corporate reporting. Financial instruments is one of the standards I personally like so much and I enjoy teaching financial instrument actually. It may not even be at this level, but at a professional level, I enjoy teaching it a lot because that is much broader, and that stirs student feelings up, you know. So this morning, I want us to look at it and complete where we can get to and leave the rest for next week as much as possible. Okay. So basically, financial instruments. Guys, can you hear me well?
Yes, sir.
Financial instruments are governed by IFRS 9 by way of recognition and measurement, and IS 32 by way of classification. So basically, but what are financial instruments? Financial instruments is any contract in which a party holds a contractual right to receive cash inflows, while another has a contractual obligation to deliver the cash. So basically, when you buy an instrument, when you buy shares, when you buy stock, when you buy treasury bill, when you buy bonds, you are in one way or the other another class of financial instrument. Now, give and take, that instrument positions one party to receive cash at a specific point in time, and then oblige another party to deliver cash at a particular point in time. So basically, when you say financial instrument, that is the meaning of it in IFRS 9. Now, classification is done by IS 32, and IS 32 classifies financial instruments into three main types. They classify financial instruments into three main types. One, financial assets, financial liabilities, and equity instruments, basically. So if you look at the standard classify financial instruments into three main types. And these are financial, don't look at it from the perspective of asset, liability, and whatever equity, no. But look at it from the perspective of what I'm telling you. Now, it is not like that. These are financial instruments that we play with on the investment and capital as well. Now, if you look at financial assets, what are financial assets? Anybody who is holding an asset is holding a right, isn't it? So IFRS 9 defines financial assets as investment. You know, when you are holding equity instrument, you are entitled to . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . you are entitled to the residual when they pay all the secured investments. The rest, the leftover, is what is shared for equity holders. So that is what it means by equity holders guarantee the holders residual interest of leftovers. Okay. So basically that is what we mean by financial assets, financial liability, and equity instrument. Let's go further. Now, IFRS 9 classifies instrument according to various approaches of valuing them. Basically, these instruments according to various assets. Under financial asset, we have financial asset at amortized cost. Okay. For people who are now coming in. Financial asset at amortized cost. Financial asset at fair value through other comprehensive income, and financial assets at fair value through profit or loss account. Basically, these are financial classes of financial asset that we have. Then we have financial liability. We have financial liability amortized cost. We have financial liability at fair value through profit or loss account. So the financial liability, we basically have two. We basically have two. Now we may not dwell much on equity instrument. We won't dwell much on equity instrument. We will look at more of hybrid instruments. And under hybrid instrument, we'll look at what is called convertible bonds next week, maybe this time. So please take note. These are the things, these are the areas that we are practically going to cover under these instruments. Are there any questions?
Hey, good morning, sir. My boss.
How are you doing? So these are instruments that have been. Please put on the AC for me.
The AC is on, but it's not going to be on 17. I'm going to drop the AC. I'm inside from the office.
Like that,
I am unmovable. Is it possible to remove me? No.
I have not seen that before.
The classification of financial instrument that we have. Now let's get into serious business. So I've run you through most of the significance. Also, champion coffee power. Okay, so IS 32 That's classification. I've explained that to you already. IS 32 classify financial instrument into financial asset, financial liability, and equity instrument, I suppose. Now, under financial asset, I explained to you that IFRS 9 does further groupings. We have amortized cost, financial asset at amortized cost. These are ways that we value the instrument. At fair value through other comprehensive income and at fair value through profit or loss account. Um, Now we have, yes, and we have the same for financial liabilities. And I want us to look at, under this complex instrument, I want us to look at it's a complex financial instrument whose classification is very, very difficult, I tell you. These instruments, when you have a question, it becomes very difficult to situate it into a particular class of instruments. So warrants and option, perpetual debt, redeemable preference share, non-redeemable preference shares complete with national laws. But I'm interested in convertible securities with options, convertible securities with options, and we will look at that side. We will look at it in more and more detail. So let's pick them one after the other and look at it. So for today, let's try and cover financial asset. Maybe. So I will take financial asset which are valued at an amortized cost. Now, what are these instruments? These are financial instruments which are held in a business model, i.e., the holder is entitled to a contractual cash inflows. Guys, take note, these are recognition criteria or principle that drives your decision to say that this question I'm saying satisfy the criteria of a financial asset whose valuation amortized cost should be the applicable principle. Is that the error? Okay, sure. Yes.
Please come again with this.
So we are building the principles that drives a decision to value a particular question using the amortized cost principle. Okay, so it's like a recognition criteria. Now, when you have financial instruments which are classified as financial asset at an amortized cost, I say these are financial instruments which are held in a business model. The focus is that the holder will be entitled to regular contractual cash inflows. Okay, now, with this class of instruments, there is an assurance of specific date for payment of principal and interest. Okay, so we usually term it at the SPPI test, which is specific date for payment of principal and interest tests. I don't have enough. Okay, then we have Then we have the third criteria, means that we value financial assets at an amortized using the effective interest rate. Okay. Now the question is, what are EIR? What are effective interest rates? What are effective interest rates? Okay. This is the rate which discounts the financial instrument to the exact amount expected to be redeemed at maturity. So basically, this plays a role of the principle of IRR, internal rate of return. When you have this applicable rate, you should be able to appraise the instrument, and at maturity, the amount that is built up at the last day on the matured value of your instrument should be exactly the same as the contractual expected redemptive amount. Please take note. And the fourth item, and the fourth criteria is that note, let me just put it in a bigger note that with financial asset at amortized cost, we add the transaction cost to the cost of your investment at your initial recognition. Okay, at your initial recognition. Okay. Yes, Mabel, do you have a question? Mabel.
No, sir.
Well, your hand is up. Then put your hand up.
Sorry.
Okay. Good. Okay, so these are what comes to mind of the recognition criteria. Let's look at what your slide says. Okay, so now the first point is that financial asset is held within a business model whose objective is to hold in financial assets in order to collect contractual cash flow, hold to collect business model test, and B, the contractual term of the financial asset give rise to specific dates. Because for you to depreciate or amortize anything, there should be end-to-end date that knows the period of the instrument. To cash flows that are solely payment of principal and interest on the principal amount outstanding. We term this as specific dates for payment of principal and interest. Please note this. Now, the next point states that an amortized cost is measured using effective interest method. Now, the effective interest rate method is the rate that exactly discounts the estimated future cash payment or receipt through the effective useful life of the instrument, or when appropriate, the shorter period to the carrying amount of the financial asset or financial liability. Of course, there are situations that the ERR will not be given in the question, and you should be able to work it out. Maybe next week we will look at how to calculate effective interest rate when you are not given in the question. Now, yes, I also indicated again that at your initial recognition, we add the transaction cost, if any, that is, if any, in the question to your cost of your initial investment. Please take note. Okay, so let's look at this quick illustration. An entity acquires a zero coupon bond. What is a zero coupon bond? Victoria, what is a zero coupon bond? What it
It's
is
an
a
it's a bond with no interest rate.
no interest rate. Perfect.
It's like
Because
it.
that's correct. Perfect. Because when you say a zero coupon bond, coupon means interest. Get out. Coupon means interest. So when you say an entity acquires a zero coupon bond, it means that an entity acquires a zero interest bond with a nominal value of 20,000. I've explained to you what nominal value of 20,000, that's a par value. That is the amount. Okay. On 1st January 2010. Now, the 1st January 2010, I mean, in of course, you are accountant. We say that transactions are recorded at the very date upon which they occur. So on 1st January 2010, a transaction has occurred and you need to pass an entry as much as possible for 18,900. So, okay, so nominal value of 20,000 on 1st January 2010 for 18,900. What does it mean? What does the first statement mean? I should believe that it means that the the instrument has been given out on a discount, isn't it? Okay. Now, the bond is quoted in an active market, and the broker's fee for 500 were incurred in relation to the purchase. So broker's fee for 500 becomes the transaction cost, isn't it? What does the principle say? The principle says that we add the transaction cost to your cost of your investment at your initial recognition. Please take note. This is redeemable on 31st December 2011 at a premium of 10%. So what is a premium of 10%? It means that this is claimed. So on 31st December 2011, this instrument will mature. And when I'm going for my 20,000 Ghana cedis, of course, you won't go for your 18,000 cedis. The repayment amount is 20,000 Ghana cedis. They gave it to you for 18,000. 900 Ghana cedis. Now, if you are going for your instruments, they will add a premium of 10%. So 10% on the 20,000 will be 2,000 plus the 20,000. So that will give you 22,000. So you go actually for 22,000. Now, the good thing is that the effective interest rate is that 6.49%. So here also the examiner is charitable and has brought to you the EIR rate for you to proceed with your computation. Now, one of the things you need to appreciate here is that you should see that it's a financial asset. Because if an entity acquires a bond, what it means is that that entity will be entitled to an interest and a repayment of principal with some gains on it. So the entity stands in the receiving end of this transaction. Required, show the relevant journal entries for this particular transaction. Some of them want to come in, they are standing at the gate. Okay, so that is what happens in this regard. So let's look at the solution. Look at the solution. Now, at your initial recognition, what are we saying? At your initial recognition, the actual cost of our investment was 20,000, but of course we bought it for 18,900. So the cash we churn out was 18,900. The rule says that so initial recognition is 1st January 2010. And we obviously need to throw out 18,900 plus the transaction cost. Transaction cost, that's what the principle says here. Okay, we add the transaction. So plus the transaction cost of 500 gives us a total of 19,400. Okay, so that's your initial recognition. Now, because this question comes specifics on redemptive dates, is the instrument started on 1st January 2010. The redeemable date is 31st December 2011. There is a regular payment of interest. Like at the end of the year, there should have been interest to be paid, except for the fact that it's 0%. Okay, so this instrument satisfies the condition of an amortized cost. Now, you need to have your amortized schedule. And I'm going to open the amortized schedule with you now. So if you look at the amortized schedule, go to insert and see what I can do here. Okay, so 5, 3. Okay. So this is a typical of an amortized schedule. You have your date. Start with the date. Please take note. It starts with the date of your investment. Then you have your opening amount. Then you have your check. The first column is always your EIR rate. Okay. In which case it is 6.49. 6.49%, isn't it? I guess so. 6.49%. Then you have also the actual interest received. You know that the holder of the instrument, the holder of a financial asset is entitled to interest received on a periodic basis, except for the fact that in the question the interest is actually 0, but the holder is actually entitled to the interest received. That's why I brought the column so that nobody will say you didn't explain this to us. The holder is entitled to a routine regular cash inflows. Then we have the closing amount, isn't it? Okay. Now, what do we do from here? We have to put the date. So initial date is 1st January 2010. That's the date the transaction take place. Yes, 1st January 2010. Okay, what is our opening amount? The opening amount will be 18,000 physical cash that we invested plus the 500, because the standard IFRS 9 says so, that we need to add the transaction cost to your initial investment at your initial recognition. So that gives us 19,400. Guys, can you work out the effective interest rate amount on the 19,400 and give it to me? Quick. We have so much to cover, please.
Hello, sir.
Yes.
1,259.
1259.06. That's good. That's good. Okay. Of course, actual interest that the firm is entitled to receive is 0, isn't it? The amount is 0 because it's a 0 coupon bond. It's non-interest bearing bond. So what is the closing amount? The closing amount is always the effective interest rate, the opening amount plus the effective interest rate less the interest to be received. So that gives us which amount, please?
20,659.
20,659.06, I guess. So that becomes your opening balance in 2011. 20,659.06. Okay. What is the effective interest rate on this amount?
1340.
340.77. So the following year interest is still 0.
0.77.
The following year interest is still 0. So what is the closing amount? Do we have 22,000 as the redemptive amount?
2199.
Okay, so 2199. Okay, so let's assume it's 20,000. It's 20,000 actually. Okay.
Yes.
So that is what we have, so to call, but we are not done yet. The requirement is that show the relevant journal entries for this transaction. Okay. So what are the JVs? Sorry. What are the journal entries? Okay. JVs are journal entries, but that's fine. We start with your initial recognition. 1st 1st January 2010. What happened? We already have it here. So we debit,
Sir,
yes,
sir,
yes.
please, how did you get the closing amount for the 2011?
But the procedure is the same. Opening amount plus EIR amount less actual interest received
Okay,
due to the closing amount. Okay.
okay, thank
So
you.
please copy your notes. I will not give my notes out. So please copy your notes along the line. Okay. Now you debit financial assets with 19,400 initial recognition. Take note on this very date the transaction take place. Okay, and you credit cash or bank because you made that investment. 19,400. Okay. What is your subsequent recognition? This will be 31st December, isn't it? 2010. That's close of the year, isn't it? But this time we debit financial asset again with 1259.06, and then we credit. This is a non-cash item. Okay, so we credit our P&L with interest gained. Of course, it's an asset. We are holding a financial instrument. So interest gained. So that gives us the amount. Further subsequent recognition will be on 31st December 2011. We still debit financial asset again with 1340.77. That's 1340.77. Then we credit P&L interest gained 1340.77. Okay. But what is the examiner's instruction? He says that this is redeemable on 31st December 2011 so it means that the instrument will be liquidated into cash. So assuredly on this very date, derecognition. Okay, of course, because the instrument is redeemed, the firm will go and withdraw his investment up. Okay, so at this very date, you debit cash or bank with the 22,000, and then you credit financial assets, at which time the amount of 22,000 had built in there. Here. So you de-recognize it, isn't it? Okay. So that is basically, and that happened on 31st December 2011 as well. Are we still done? No, we are still not done. Why are we still not done? And where do we go again from here? We need to prepare the P&L extract and the balance sheet extract now for 2010 and 2011, and then also for 2010 balance sheet also for 2010 and 2011. And the P&L extract, we have after gross profit, we have what is called other income. And then other income, we report interest gain. This is not a financial liability, this is a financial asset. If it were to be financial liability, we would have prepared interest expense. So that's 1259.06, 1340.77. Okay. Then balance, we have non-current assets. And the non-current assets, we have investments, isn't it? Financial assets. The The closing amount is 22659.06. 22659.06, and then do we have 22,000? I don't think so. I don't think so because at which time? I don't think so because at this date, the amount has been liquidated into cash. When you come to current assets, you have cash and bank. Of course, 2010, did we receive any cash? No, because of course it was a zero coupon bond. So zero, but in 2011, the 22,000 has eventually come in. Okay. Guys, are there any questions? Yes.
Please, looking at the balance sheet aspect.
Yes.
You said, is it because it has been liquidated? Is it at the beginning or the close of the year that they have?
It was close of the year. It was close of the instrument. I mean, the examiner was very direct. He said that this instrument is redeemable on 31st December 2011. Is that not it? At a premium. Okay. Please ask your questions. So, those of you who are copying, please copy before we take up to other areas. Okay. Are there any other questions? Are there any other questions? Beautiful. Beautiful. If there are no questions, it means that it means two things. Either you are making noise, hurry up and go and let us go and find something to eat, or we understand everything that you are saying. So that is me. Questions. Yes, please ask your question.
Please, I want to see the solutions at the top.
Yes, they are here. Okay, if you want to go up, should I go here? Yes. We started from here, basically. Okay, so I think we can quickly look at another scenario. I was expecting a question that said when there is actual cash received or interest bearing, how would the journal voucher look like? But that's fine. Let's still press to see the way forward with this. There's a question I want us to look at it now. NPK Financial Services has agreed to lend a customer. And again, one interesting thing about financial instruments is that every question is unique in its own approach. Every question. I tell you, every question is, you will come across many questions. When we resume on the first day, you write a test. And it will cover everything that you have done whilst you are home, eating your banku and all of that. So be getting ready. Okay, so has agreed to lend a customer for 9,500 on 1st January 2010, subject to the following terms. One, the loan is repaid on 31st December 2012. How many years is this facility going for? How many years?
3 years.
3 years, okay. 3 interest payments of 1,000 cedis are paid on 31st December each year, So this is not a zero coupon investment. This actually comes with every year NPK will receive 1,000 cities as interest payment every year. That's good. Three, NPK incurred 250 cities of legal fees in agreeing the loan documentation with the customer. Obviously, there's a transaction cost.
Yeah.
It ought to be added to your initial investment. Again, also this question, the examiner had given you freely from his heart the effective interest rate at a percentage of 9.48%. Now, require demonstrate by journal entries how the loan should be recorded in the financial statement of MPK for the year ended 31st December 2010 and the subsequent years, I suppose. So let's quickly look at it, and then we can turn our attention to other pressing needs. Uh, what do we do? Let me go there. Okay. So let's take note of the few things. The investment, MPK had to lend 9,500 to the customer. Okay. So if MPK lend to the customer and you are demonstrating the journal vouchers in the books of NPK, then NPK is holding an asset because the MPK lent, so he will be entitled to interest and all of that. If MPK lent to the customer and you are demonstrating the journal entries in the books of the customer, then from that perspective, it will be a financial liability. We will look at it next week. Now, my assumption is that at my initial recognition, it will be the initial amount plus the transaction cost. Because that's what the principle of financial asset at amortized cost says. Let me see. Oh, very tired. Financial assets. Okay, so let's say solution to the NPK question. Okay, so now, let me go to the amortization schedule. Okay, so if I open up this, oh, we don't know how to play around with documents. Hey, I have to learn it too. And then you have EIR rate. Which percentage was that? 9.48%, 9.48%. This is actual interest received because we are doing it in the books of NPK. Now, when you come to financial liability, it will be actual interest paid because you are liable to pay to deliver the cash. Okay. Person amount. So on 1st January 2010 again, what is our initial recognition? That will be the 9,500 plus the transaction fee of 250. Now, if your working is correct, plus 250, this will give us
9,250.
Good. Now, if your working is correct, at 2012, of course, MPK at the mature date of 2012, 31st December 2012, will be going for his 9,500 cities. So if our amortization schedule computation is correct, then at 31st December 2012, we should see 9,500 here. Okay. Please, can somebody work out the EIR rates for me?
Okay, sir.
Yes.
Sir, please come again with that aspect. You said why would you be left with the 9,500?
Yeah, because your ERR rate and your computation, if it is correct, because what is amortization and what is a sinking fund? You allocate the funds into a fund so that at the date of maturity you can pay the instrument, repay the instrument, or receive the expected cash inflow from the instrument. And again, also, when you lend on the last day of the instrument, you go for your principal. You go for your principal. Okay. So if it's the same thing, we've not departed from any principle. It's the same. We said that if our computation is correct, at the last day we should have our 22,000, and we got the 22,000. Except that when I bring it to the exams, you may struggle and not get the exact amount at the last date because of the nature of the question. But if your computation is correct and your understanding of the question is accurate, you should be able to get the exact amount which is expected to be redeemed at the last date of the instrument. Is that okay with you?
Yes, sir.
Of course. Are there any further questions? Okay, so somebody should work out the effective interest rate for us, please.
924.3.
924.3. Is that so?
Yes, sir.
Yes, sir.
Now, the examiner says that three interest payments of 1,000 Ghana cedis are paid on 31st December each year. So MPK will gladly be receiving 1,000 cedis each year. Now, what is the closing amount?
964.9647.3.
Is that the closing amount? Check for me, please.
Please 47.
Please, can
964.
somebody double check this?
9674.
7.
74.3.
My lady, please double check your figures again.
Okay, sir.
Okay.
Hello, sir.
Yes, our
Yes,
friend.
please. Yes, where did you get the 1,000 from?
Yes,
My line was-
yes, because this is an interest-bearing debt. It was not a zero coupon bond. That is why NPK that was lending. These were the terms, and it says that three interest payment of 1,000 are paid on each year, 31st December each year. And who is going to pay that? It is a customer NPK had lent to that will be paying NPK. So NPK will be receiving the interest. Okay.
Thank you very much.
Okay, thank you. Now, when you come to 1st January 2011, the amount opens here 74.30. Can somebody work out the year rate for us?
917.13.
Your voice is down. I can't hear you.
917.13.
113. Okay, good, 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 good. What do you have for actual interest received is 1,000. So what is the closing balance? What is the closing balance? That's at 31st December 2011.
9591.43.42.
We have first,
9591.
so I have the 1st January 2012, which is the last day of the instrument, last year of the instrument. What's the year rate?
Nine.
What is the year rate? Are we here?
909.2.
909.
909.
909 point.
Okay, try. That's fine.
0.27.
Okay. This is 1,000. Do we have the 9,500?
Yes.
So,
It's 1,500.6. Sorry.
do you have the 9,500?
Yes, please.
Okay, good. Now, what are the journal vouchers to be passed? 1st January 2010, your initial recognition. At your initial recognition, you debit financial assets with 9750, and everybody knows why we debited with 9750. Then you credit cash or bank with 9750. Then on your subsequent recognition, 31st December 2010, the same year, you debit what? Cash coming in into NPK. You debit cash or bank with 1,000 because MPK is receiving cash or bank cash with 1,000. And then you credit P&L with interest gained, which is 924.30. And the difference goes into financial instrument. There's a credit difference. Financial assets. What's the difference? I think 75.7. Somebody should confirm for me, please. Is that correct? The difference.
Yes, please.
Okay. Now, what is the subsequent recognition again? 31st December 2011, you debit cash or bank with 1,000, you credit P&L interest gain with 917.13, and the difference goes to credit of financial assets with what? I think this should be 82.87, I think. Double check for me the difference. At 31st December 2012, what happened? You debit cash or bank with 1,000, you credit P&L with interest gain of 909.27, then you credit financial asset with a difference. This will be 20.73. How are you doing? 20.73. Are there any questions? So who are doing who are copying, please copy quickly before
Hello.
Yes.
Please, why do we credit the financial asset 75.7?
Yes, you credit financial asset with a difference because it is a holding account of the year-on-year changes between the actual cash that we received and then the effective interest rate that we compute for. So if the actual cash we received and then had been less than the effective interest rate to be worked for, then of course it would have taken a debit position. But if you look at cash is coming in of 1,000, and you have an interest gain of 924. It leaves you with a credit balance gap of 75.70. That should go to your financial assets credit. Okay.
Okay.
Are there any further questions? Those who are copying, please copy quickly and let me do the extract and move to another heading.
Hello, sir. Hello, sir. Hello. Hello.
Okay. So, yes.
So, sir. So,
Yes.
the credit of the financial assets, the difference. So I think if you add the three difference to the closing value, it will give us the initial right.
If we do what?
If you add the three differences between the credits, the credit value, the 75.7 and the 82.87,
They will do what?
like the differences,
Yes.
those three differences,
Yes, I'm with you.
if you add them,
Yes.
whether the closing value, the one in the amortization schedule, they have to give you the initial recognition value, right?
No, you just have to follow the principle. Financial asset is an asset, has a debit entry. So if, of course, initially you open up your book to debit, isn't it? So if year on year it happens that you are holding a credit balance, then it means it's definitely going to be a reducing strength. Now, if it's going to reduce it, then definitely at the end of the focus of the amortization schedule is that at the last working day of your period, you need to be able to get the redemptive value that you are expected to claim. That's why we amortize the instrument. Give and take. If you take the debit balance that you raise on your initial recognition, less the periodic deductions that comes in, it will leave you the balance that comes at the end of the maturity. Okay.
Okay. Thank you very much.
Okay, thank you. Okay, P&L. Should I leave the P&L extract for you and do?
Yes, please.
And then the balance sheet extract. You let me do it. Let me do my own thing and walk away. Interest gained is 924.3, 924.30, 917.12, 909.27. Balance sheet extracts NCA, non-current asset. We have investment, which is financial asset. 2010 closing balance was 9674.30. 9674.30. 2011 9591.42. Princess, 9591.42. When are you putting together the latest?
Full royalty for your contribution, you have to pay contribution.
How much is it?
You don't give them
How much are you planning to give me? Let's aim to do like 2,000. Let's aim to do like 2,000, yeah? Then at the year 2012, the instrument has been redeemed, so there's no closing balance. Current assets, you have cash or bank. 2010, we received 1,000 coming in. 2012, 1,000 coming in. 2011, coming. 2012, 10,500. That is the redemptive amount, 9,500 plus that last day of the year's installment. Two comes in to give us 10,500. Okay. Are there any question, please?
Hello, sir. Hello, sir. Hello, sir.
There's management never, but that was the senior management office. Okay. Were there any question?
Yes, sir. Somebody want to ask.
Were there any question?
Yes, they were.
Okay, please ask me. I stepped out.
The redemptive value for the 2012,
Yes.
that part is not clear to me, please.
Okay, so that is, you see, the instrument requires that every year you go for 1,000.
Okay.
You see, but you will, at the last day of the year, you will be entitled to this 1,000 plus your principal.
Okay.
Okay. Okay. Okay, guys, let me just spend 30 minutes of your time to do it. I really aiming to complete financial assets so that I can leave financial liability and hybrid instrument into the corner for next week. I want us to look at financial assets at fair value through other comprehensive income. Through other comprehensive income. What is this instrument? Guys, take note. 1. These are instruments which are held available for sale. We used to call it available for, it was not even at fair value to other comprehensive income. It was not there. We call it available for sale financial instrument. So in most questions, the examiner will tell you that these instruments have been designated for sale in a discontinued business operation. Of course, the examiner can also be direct and tell you that the management have decided to value this instrument through other comprehensive income. Okay, but basically these are instruments which are held available for sale. Okay. Now, this is also held in a business model to a contractual inflows. Okay. Now, with this instrument, with this instrument, the holder, with this instrument, we add the transaction cost to your initial investment. So let's also not confuse that with this instrument, we again add the transaction cost to your initial investment, please. And also take note.
Hello, sir.
Yes.
Sir, please, you said with this instrument we add the transaction costs. Like
Mm-hmm.
you've omitted the costs from there.
Yes, I'll add it for you at this date. What are you going to do? Do I do that? Okay. Good. Sorry, I'm coming. You need to start cleaning up your books now. Sorry, guys. So, okay, now this the fourth one principle is that year on year fair value gains and losses are reported through OCI. Please take note. We don't report it through P&L. We report it through OCI. Take note. Number 5. Upon disposal, we do two things. A, any gain or loss on disposal is immediately reported in P&L. Okay, on disposal, any gain or loss is reported in the P&L. And 2, any loss or gain which has built up in the OCI, as a result of the year-on-year changes for years, should be recycled back into P&L. So take note of these changes. Take note of the principle that guides us on each of these instruments. I'll proceed from here. Okay.
Hello, sir.
Yes.
Please, the loss or the gain, is it the fair value loss or?
Yes. The fair value loss and the fair value gain. I mean, the name even makes sense, isn't it? It says that fair value through other comprehensive income. So we report them there, I suppose. Now, the fair value, the financial asset as fair value through other comprehensive income are held in a business model which objective is to achieve both collecting contractual cash flows and selling the financial asset. So any gain or loss in the increase in value should be recognized in OCI and held in equity. Now, any loss arising from decrease in fair value should be recognized in other comprehensive income and held in equity. So take note. Now, when I don't want to talk about any issue of impairment, actually, whatever we are taking you through, like you can have a good amortization question with the impairment built in there, with hedge accounting built in there. We've taken all of them out to make it very, very simple for you. Okay. Now, when available for sale financial instrument is disposed of, the cumulative gain or loss. So when there is a disposal, any gain or loss is immediately recorded in the P&L. And this process is known as reclassification adjustment. This will typically involve greater frequency and involve a sale of financial asset. Okay. And what happened after you have disposed of the asset? It means you de-recognize the asset. So what happened to the routine year after year loss or gains you have built in the OCI? And that's where the instructions are that upon de-recognition, the net cumulative fair value gain or loss are recycled to P&L. Okay. Now it's really a principle that guides us. When there is a debt instrument, we recycle. If it is an equity instrument, we don't recycle. No recycle. But I just don't want to confuse anybody with this kind of jargons. Everybody should recycle everything that is sitting in the OCI when you need to recycle, because I don't want anybody to be thinking about these complexities. Whatever is sitting in the OCI, recycle back into P&L. Okay. Now let's look at this question. P purchases 1,000 shares in a listed entity X. So P purchases 1,000 shares in a listed entity X. The shares were acquired during 2008. Let me assume 1st January 2008 at 118 Ghana cedis per share. Transaction costs were 2,000. Now, what happened to transaction cost if it comes to mind? At this level, we add the transaction cost. Excess shares are quoted at 31st December 28 date at 112 Ghana cedis. P has classified these shares as available for sale. Now, one thing you need to know that once you see the available for sale instrument, it should prick you that this is a fair value. This will be valued at fair value through other comprehensive income. Okay, so just take note of some of these basic differences. Let's look at this question. Solution. What is our initial recognition of a transaction that occurred on first the world and so. Okay, so a minute. Okay, 1st January 2008. You have your initial record. Okay, so let me just pick this one up. At your initial recognition, you have the instrument was 1,000 shares, 118 cedis per share at 1,000 shares. That gives us, what's the question? 1,000 shares at 1,000 per share. So that gives me 118,000. What is my transaction cost? So total investment to be capitalized is 120,000. What is the JV? On this very date, the JV will be debit financial asset with 120,000. You credit cash or bank 120,000. Okay. Now let's see what happened. That was 1st January 28 when the transaction take place. Okay. By 31st December, the shares have lost value. Okay. Excess shares are quoted at 31st December 2008 at 112. So even if you look at the price you bought it and the value of your investment now, it has lost value at 112 per share. So in your subsequent recognition on 31st December 2008, shares are traded at 112 per share at 1,000 shares, which gives you 112,000. Now, your carrying amount or carrying value is 120. That's what you have recognized already. 120. So your fair value loss is a loss. Is 8,000, I suppose. No. So what will be the journal voucher for this 8,000? We are going to debit other comprehensive income OCI with 8,000 and credit financial assets with 8,000. Okay. With 8,000. So that's what happened. That's what happened. Now there is a continuation to this question. If you come further down on the assumption of due recognition, so that was 28. So it says that if the shares were sold during 2009, which is the following year, for 119 per share, how will the computation be dealt with? Now, this is 2009. Shares sold for 119 per share. Now, technically on disposal, okay, we dispose it for 119 per share at 1,000. That will bring us cash of 119,000. But what is our carrying value? Now, our carrying value, as at the immediate year we close, which is 2008 December, was 112. Okay, so that is 112,000. Then, so we've made some gain. So gain on disposal is technically 7,000. Gain on disposal is 7,000. Now, what happened to this disposal gain? You immediately report it in the P&L, but of course the shares have been disposed of, so we need to de-recognize this. We debit cash or bank with 119,000, which is the money coming in upon disposal of the instrument. You credit financial assets with 112,000. You credit P&L with the gain on disposal, which is 7,000. Now the bigger question is, what happened to the 8,000 loss which we have already built in the OCI in the past? Okay. What happened to the 8,000 loss which we have built in the OCI in the past? This is where we need to recycle. Okay. So we then recycle the OCI loss. So we debit expense in the P&L fair value loss of 8,000, and we credit OCI other comprehensive income 8,000. Are there any further questions?
So
Yes.
So I'm a little bit confused from the point where, like, the point above the recycle OCI loss.
Here?
Yes, please.
What are you confused about? I don't know your confusion. If I know your confusion, then I can help you.
Okay. So,
Okay.
So please, brother. Okay, so the 119.
The 119 was a disposal.
Okay.
So we have sold the instrument. So we are getting 119 Ghana cedis per share for 1,000 shares we sold off. So we got 119,000. But already the carrying value, because remember we revalued the instrument in 2008, the 3rd December, and the value was now 112. So the carrying value was 112. That gave us the disposal gain of 7,000. Okay. I'm busy.
It's what I
Yeah, but keep it there for me.
finish it today. We want to close.
God, pressure is too much. Okay, so, sir, are you fine?
Yes, sir.
Okay, thank you. Are there any further questions, my ladies? Is it fine? Victoria, all of you, Victoria, Tete, Estelia, Mabel, are you okay?
Hello, sir.
Yes.
Yes, please, we are fine.
Another question.
You,
Sir,
you are minding your SRC business, you are telling me you are fine. Yema,
sir.
go ahead.
Okay,
Yes.
please. Why is it that we didn't pass the 7,000 to the OCR, but rather the PNL?
Because we have disposed the asset, and the instruction was that upon disposal, you stop passing anything through OCI. I said upon disposal, we do two things. You will remember if you can see my screen. Any gain or loss
On this round, okay.
is immediately reported. You see, the point about accounting is to be strong on the principle that underpins a particular standard. Because if you are firm on the principle that underpins a particular standard, no question should trick you. No question should trick you, no matter how complex the question is. You should be
So,
able to appreciate the principle. Yeah. Who again is going? Another question. Yima, are you saying something?
okay. No, sir. No, sir.
Now, thank you very much. I want us to spend 5 minutes to jump into the third aspect and leave you. Fair value, true profit or loss account. No, true profit. Where is it? No, I want this one. Okay, so let's do financial. Let's complete financial asset with the third option. Okay, fair value, true profit and loss account. Now it looks slightly the same as the fair value, true other comprehensive income. Slightly different. Now, I'll explain to you the difference. Now, when you talk about financial assets as fair value through P&L, yeah, these are instruments which are traded. When you say the instruments are traded, it's not like somebody asked me what's the difference between this and available for sale. There's nothing like when you say an instrument is traded, it means it means the instrument is listed on the stock market. Okay, all other financial assets which are not mentioned above belong to this class of financial assets. Okay. Now, one thing you need to know is that with financial assets at fair value through profit and loss, we do not add the transaction cost. I remember when you go to CA examination and you trick student a little, some are adding transaction costs, some are not adding transaction costs, and you wonder why. These are basic principles that should guide you. You should know that on this strength you don't add, and then on this strength you add. Now, with fair value through profit and loss account form of valuing financial instrument, we do not add the transaction cost to your initial recognition, your initial investment or capitalization. We expense the transaction costs as soon as they are incurred. Okay, take note, guys. Of course, routine routine year-on-year changes in fair values are recorded through P&L. So what this saves us is that you will not even be having a burden of going to OCI to recycle anything. Actually, it's pretty straightforward, and that's why I am oftentimes not interested in that. There's a question that's a very simple, basic question here. You can try your hands on. I just want to use the same scenario to illustrate this class and then show you where the differences are likely to occur. Yes, we sold. So I'm assuming that the examiner says that P has classified this instrument as fair value through profit or loss account, or as traded instrument, or they can say that these instruments are traded on the stock market. It should all tell you that you would have to appraise the instrument using financial assets, a fair value through P&L model. Now this is 1,000 shares acquired at 118 in 2008. So let me show you with a transaction cost of 2,000. So I'm assuming January 2008, isn't it? So what is your initial recognition? You have 1,000 shares at 118 per share. That gives you 118,000. Immediately you debit your financial asset with 118,000. You credit cash or bank 118,000. You debit expense P&L transaction cost 2,000. You credit cash or bank. So you see the distinctive difference. Now, in your subsequent recognition, the 1st December 2008, I remember the value has fallen to 112 per share at 1,000 shares. So that gives you, however, the carrying amount is 118, not 120,000, 118. So you notice that the fair value loss is actually 6,000 instead of the previous 8,000 we got. And even in which case we just debit expense in P&L with fair value loss on asset. That is 6,000. Credit financial assets with the 6,000. Okay. So that's what happened. And again, also we realized that in 2009, the asset was disposed of for 119 per share. So in 2009, disposal of assets for 119 per share. So that would be 119 per share at 1,000. That gives us 119,000. We debit, and then the carrying value 2,000. In on disposal 7,000. Then we debit what? We debit cash disposal, cash or bank 119 coming in. Credit financial assets 112,000. We credit gain on disposal. P&L 7,000. is in all these scenarios we have done under financial asset at fair value through profit or loss account, and again also financial asset at fair value through other comprehensive income, you should be able to do the P&L extract and then the balance sheet extract. It's not something that is too difficult that you will not be able to do. So everyone should learn how to do. In fact, when I ask you a question on any of the type and you don't do the extract, I'll mark you wrong. I'll deduct some marks from it. It has to. You should be able to go and learn how to get the extract out of this. Are there any questions? Are there any questions? Am I really in the class? Am I really in this class? Or
Yes, sir.
yes, Ima. Right. Oh, it's looking more interesting. Are there any questions?
So, hello, sir.
Yes, I'm with you, Ima.
Does it mean that because the gain on the financial asset is already captured in the 119, that's why we didn't go ahead to debit it or to credit the financial asset again?
The gain on the disposal is not already, the carrying value is 112,000 sitting in your financial assets.
Yeah.
It's been disposed anyway, so you don't need to report the 119 there. You just have to write it off. That's why we credit the financial asset, which is already debited with 112. We credit it to 112 so that it comes to zero.
Oh.
But the good thing is that the money that we are receiving is 119 because that's the market amount that we got. So it projects a clear gain of 7,000 to us,
Okay.
which has to be reported to P&L for tax purposes. Okay.
Okay.
Yeah.
So meaning at the end of the year, this asset will not be there again since it
No, it won't be there because it's been disposed of. That is why we have de-recognized it from the assets, non-current assets. Yeah. I know you are thinking about how you prepare your extracts, so that's fine. At the end of 2009, there wouldn't be any value for financial asset. That's correct. Okay. Are there any further questions? Okay. There will always be silence, which means that everybody understands all the things that we are doing. Please, if you understand what we are doing, assist your colleague who doesn't see what we are trying to talk here. Okay? Because that's where we find ourselves corporate reporting too. So please, if you don't understand anything, let your colleague assist you so that you can touch base or catch up with us, okay? Because you need to understand it. You need to understand it so that you can do well in your exams, okay? Okay. Thank you very much. I wish you all the best. Enjoy the rest of your week, okay? Thank you.
Thank you, sir.